You mentioned stock options, and I want to circle back a little bit briefly. Obviously, things can get kind of technical, but they're really common in some sectors, pretty uncommon in others. So it's not impossible that a worker could be running into them for the first time further into their career. For our listeners, whether or not they're familiar at all, what are just some basics you think someone should know if they're encountering stock options in a job offer for the first time? How do they work?
Yeah, so that's a really good question. So there are many ways for a company to offer equity to employees in the company. When you're evaluating a job offer, you'll kind of want to know some of the basics of the different types of equity compensation. So there's what people refer to as restricted stock units, incentive stock options, non-qualified stock options, qualified small business stock. So they're all different acronyms. QSBS was the last one. It's kind of like a menagerie of different options and is pretty confusing to begin with. But really, on a basic level, it is either offering you some kind of phantom investment in the company, or in the case of options, the option to potentially purchase shares at a set price for a company. So if a company offers you the right to purchase shares for $10 and it's currently trading at $10, that stock option is essentially worthless because I could go out into the stock market and buy stock at the same price. But if I have the option to buy something at $10 and the stock increases to $50, that has quite a bit of value to it. So especially since you're not putting money into these stock options to begin with, it's a really leveraged way to increase your wealth. And a lot of times the stock options will be structured in a way where they're vesting over time, they're being issued over time, and then you have to stay with the company until a set period before you are fully vested in the options. There's a ton of planning opportunities and different income tax consequences that apply to these different options. So it really is important to talk to an advisor to really understand what the net impact to you is. It's totally different tax consequences. And then also whether you have to actually buy the stock for the grant price, or if you just are granted restricted stock units, you just receive the stock when they vest. So it's different in terms of what kind of cash outlay there might be. And then really one of my favorite planning techniques with equity compensation is tax code section 83B election that allows you to include stock in your income, even if it's not fully vested. And so that example that I was using before, if you have options at $10 and you want to include it in income, then that's going to be a lot less income than if you were to include it when it vests, when maybe it's $100 a share. So it's a great way to kind of get the capital gains clock running on that kind of equity compensation, because you get to decide whether it's taxed as capital gains or ordinary income. To put it briefly, there's a ton of planning opportunities. There's a ton of growth potential, but there's also a lot of risk.